Hey guys, welcome back. I'm going to show you today how to use the IV Crush tab within Quantor.net that I introduced last week. And we'll go into a little bit of detail. You may notice the background's slightly different. I am on a cruise, but I want to do this during the middle of the day with Dollar General because Dollar General is a good candidate to play. We're going to enter the trade on Dollar General. I'll show you how to do that. And without further ado, let's jump in. So let's take a look. First, we'll go into the tools, IV Crush candidates. We'll need to log in, and there we go. Click on IV Crush. All right, this is what the screen looks like. What we're looking at here are candidates that have earnings today and tomorrow, and so on and so forth. So we're coming up to the end of earnings season, and it's already preloaded with what the average move is over the last several quarters, the average up, average down, max move, and so on. So if I go in, first thing I'm going to do is click Load IV. I'm going to enter these trades at around noon. Some people will say enter it closer to the afternoon, about an hour or 30 minutes before market close, because implied volatility would be the greatest. And that's true. But there's times when if you do it around the lunchtime, let's say around 12, 1 o'clock, you may have trades that you can enter more than one. And then by the end of the afternoon, IV is already starting to collapse and you can actually close out a trade before even the earnings. So I've seen that from time to time. But let's just say we're going to do this around 12, 1 o'clock. What time you enter is personal preference. Definitely don't do it in the morning. Do it later in the afternoon. So what I'm going to do is I'm going to click Load IV. It's going to go out and pull real live data, option chain data, and it's going to highlight what candidates might be good to trade. So take a look at this one. So it highlighted it. And the reason why it highlighted it is because the average move is expected to be 13%, but what's being priced in is about 20%. What that's doing is it's looking at this Friday's pricing and it's making a determination of what the implied move is, and that's based on the at-the-money straddle price. Then it goes out and it looks at the back month. So it's going to pick the nearest monthly, which would be June 18th in this case. Today is June 1st, so it's going to look at June 18th. It's going to look at that straddle price, and it's going to determine what the expected move is then. Based on the delta between those two, as long as it's over 20%, this is going to highlight. So it just makes it super easy. So you can go look at the earnings calendar for all the stocks during earnings season. That could take a lot of time. This simplifies it and says, give me where expected move is greater than the average move and where the implied move this month is a lot higher than back month. All right, so I have a candidate for today, and then I'm going to click Load IV again for tomorrow, see which ones are showing tomorrow morning. Now, this is loaded at the beginning of the quarter, so earnings dates can change. So I would highly recommend to validate these dates. So today I've looked at DG, looked at Alta. I'm not going to play Alta because the bid-ask spreads are quite wide, but DG, Dollar General, that's going to be one that I'm going to play. It's highlighted a couple of these. We'll go look at the platform here in a second. We'll look at our trading platform where we're going to make the trade. So let's take a look at DG. I like this one. It's currently priced at around $109. Expected move is 9.3%. So plus or minus 10 or so dollars. I'm sorry, this is the average move, but the expected move is 11%. So that means plus or minus 11 or $12. So take a look at this, double click on this, and it pulls the last 3 years, 11 quarters worth of data. It says what the average move is. So we want to make sure that when we're placing this trade, do we have the probabilities in our favor? And it looks like we do. So the last quarter was 6%, 14% back then, Q1 of 2026. Let's see, the date on that was, what is that, June? So last year was 16%, so on and so forth. And you can see some of these bigger moves like this 32% move. If you have a move like that tomorrow morning, that is going to be a bad play. You'll have a loss. Where you make money is when tomorrow's move in this case is less than the expected move. Now, you can still make money if the expected move is 11% and it actually moves to 11.5%, 12%. You can still close out first thing in the morning at a slight profit. But the idea here is that tomorrow's move, we're putting the odds in our favor that based on the averages of the last several quarters, that tomorrow's move is going to be on average around 9%. What's being priced in is 11. That's our edge. What this thing does is it goes out and pulls the previous 12 quarters roughly of earnings, tells you what the expected move is on current options pricing, looks at the averages, and then makes a determination based on the back month's pricing as well, what the delta is. And if it meets all those criteria, it highlights it and says, hey, you might want to take a look. Now, on some of these, I only trade these candidates when you have an options date of this coming Friday. If the next date is 2 weeks from now, not going to play it. Only if it's this Friday compared to the next monthly Friday. So just keep that in mind, and we'll look at that here in a second. This is the payoff diagram of a double calendar. This is exactly what we're playing. We're selling a front month straddle. We're buying a back month straddle. Now, some people will sell a front month straddle. That's where all the premiums built in. They will buy that back month straddle, or they might buy a back month strangle. But when you do that, the risk is higher. It's better to sell it at the money straddle and buy a back month straddle. Otherwise, if you buy a back month strangle, if it's too wide, that front month, if you have a extreme move one direction or another, it can crush you. So typically the most safe play is to at the money straddles. So this is what the diagram looks like. If everything works out, and let's say that this particular trade, it's $2.40 or $240 per straddle, where it will make the most money is if tomorrow morning it doesn't move at all. If it stays within this range, you'll make money. If it moves beyond, but it has to move a long ways beyond, your typical break evens on $2.40. So your typical break evens at 110, it's going to be roughly 112, 113, 107, 108. Ish. That'll be where you're breaking. As long as it stays within that range, you'll be profitable. Now, it can move 10%. That's based on if you let the whole thing just expire. That would be the front month expiring as well as the back month, and we keep it all the way to expiration, which we're not going to do. We're going to enter this trade in the afternoon and close it out first thing tomorrow morning, 5 or 10 minutes. So that $2.40 that we're buying is the maximum risk if we keep it all the way to the back month expiration. Tomorrow morning, if it stays within that 9% or 11% that we saw earlier, then we will be profitable. So that means our break even tomorrow is going to be somewhere between $99 and $120, right? All right, let's take a look at the platform. All right, so here's the platform. Got it pulled up on Dollar General, and you'll see that the price is roughly $109.57. So what we're going to do is, if you look at the top of the screen, I have the options chain pulled up. Here's chart, research, options. All right, so we're looking at, if you look to June 5th, this Friday, 4 days. If you look over to the right, it says plus or minus $10.29. That is the expected move based on 111% implied volatility. Let's go down, and there's our 109, 110. That is up to you whether you decide to go a little bit below the price or a little bit above the price. I try to be right at the price, as closest to the price as possible. So what I'm going to do is I'm going to select the call and the put. This is now a straddle. I'm selling those two, and that's roughly, call that a little over $10, so 10.50 ish. I'm going to scroll down and pick up my June 18th. Now that's 2 weeks out. I typically like to be a little bit further out than that, but sometimes if you go into these weeklies, you have less liquidity and they won't make good candidates. Now take a look at this June 18th, 69% volatility with a $13 expected move. So we've got about a $10.50 move expected this Friday and 13 towards the back of the month. Well, it's only going to move another $2. That's what's expected. So that is what I'm looking for. 69% there, 110% there. That is a great candidate because it's about 40 points apart. Now let's take a look. We can buy these two, 670, 690. Click next, and look, it's $2.20. That is the candidate. That is the price that I'm going to pay. So I can lock that in. I can go look at my bid ask. Now, when I look at these bid ask, if you see it's 95 cents and $3.50, that's to buy all four. If you look at a particular one and you look at 110, 110 on the calls and the puts on, let's say June 18th, look at the bid ask on that. It's only about 50, 60 cents apart, right? Now that bottom one is 690. This is the only thing about Thinkorswim. Sometimes if you try to hold it there, it wants to move out and it moves beyond. It's a little bit annoying, but you can see all the strikes, all the different calendars. You can see that the difference is roughly 70 cents. That's not a bad bid ask. If it was wider than that, sometimes you'll see these candidates and they'll be $2 or $3 or $4 wide. I don't trade those because if I need to get out of that, I don't have a friend on the other side to help me get out. There's no liquidity. In other words, I'm looking for very liquid stocks. The Dollar General met that for me, and I'm going to go ahead and place this trade. So I'll set it somewhere in the middle. We'll pick $2.20 for now, and that's up to you. That's the most risk. That is the most risk if I decided that I wanted to keep it all the way to the end. That is the most risk. All right, so 220 is my max limit. My max risk, click on the risk profile, and there's our profile. And you can see, look at that blue line. By this Friday, my profitability is somewhere around that 99 to up to $100 $122. ish, give or take. And that'll also depend on how far the back month straddle collapses. If that collapses a lot, then the profit's only going to be the $9 move that we saw earlier, or $11 move that we saw earlier. So all that said, that is what the trade looks like. So click review, 220, we'll just do the one, execute, go back and view the order. Sometimes I like to let them sit for a little bit and see if somebody will pick it up at a cheaper price. But for the purpose of the video, let's go ahead and go up to 230 because that's now the new price. All right, I'm also doing this on a paper account. So that is it. That's it. That's how you play an IV crush trade. They are very fun to play with the tool on the website. This tool right here is very nice in that it highlights, makes it super simple, and that is it. Also, I don't play candidates in this range. $1.37, $4.54, I'm out. But I highlight it there, so if you want to take a look at it and you like it, that these aren't good candidates for me because just how far the options are away from the price, it just doesn't work. That said, I hope you enjoyed this video. Let me know if you have any questions, and happy trading.